Take a look more broadly at the market, specifically the US market, because of course we do take those leads, those record all-time highs that we are watching at the moment over in the US. Chad Slater over at Morphic Asset Management is joining us live now. And Chad, you've been drawing these resemblances between this market and those of 1999 and 2007. What is it about this year, 2017, that's similar to those years?
Yeah. 99 and 2007, and what's happening this year is what I would point out is, as you said, Nasdaq making new all-time high. Overnight, people talking about Amazon going through $1,000. At the same time, you've got people buying emerging markets, or commodities are back. So it's got this little sense of euphoria starting to build. And if your viewers remember correctly, 99 and 2007 were the last 12 to 18 months of those respective bull markets.
Yeah, just with, those valuations, you mentioned there, those all-time highs, and I think there's been a lot of question about whether stocks are too highly valued at this level. Of course, coupled with that low volatility, I think we're all wondering how much longer this can last. Maybe this is potentially the calm before the storm. What do you think about, say, some of those comments?
Yeah, one of the interesting things about the end of bull markets is, look, valuation's always very high at the end, but there's a real tendency for markets to actually keep going even higher. And the other weird thing is volatility actually stays low at the end. So valuation doesn't really help you very much towards the end of a bull market. So you've just sort of got to stay in there, I think, at the end. And you saw this week, obviously, Altair said that they'd had enough and they're going to get out. But on our analysis, all the things point to at least another 12 to 18 months to run if we use some forward indicators of economic stuff that we build out our models internally.
Is it fair to say that, say, the Aussie market has been a bit late in the cycle, a bit late to the party? Because if you look at the comparisons, year to date, our market certainly hasn't seen those gains that, we have in the US, for example, or even over in Europe. Are we late in the cycle, and is there a problem that comes with that?
Yes, I think overall the global economy, and particularly the US economy, is very late in the cycle. Europe and Japan, perhaps not so much, and emerging markets as well. But if I turn to look at Australia, as you mentioned, the biggest problem here is the index doesn't look like the economy. And what I mean by that is the index here accounts, banks are a very large portion, and clearly, as all your viewers be aware, the bank levy has accounted for a lot of the downward and negative momentum there. And then on top of that, you've got resource stocks, which account for another large portion of the market here. And with iron ore prices falling 30% year to date, it's going to be very difficult for a lot of those stocks. So the issue here is our stock market doesn't look anything like our economy.
Yeah, interesting. Where do you think our Aussie market's going to go from here?
So yeah, just touching back on those two sectors, really to have a view on the ASX 200, you've got to have a view on the banks.
Yeah.
And you've got to have a view on resources, basically. I'd have to say somewhat negative is our house view on both these. The banking sector, if we look at the US housing bubble, a lot of the stocks, the housing-related stocks, actually peaked out at least 18 months before the actual economy tanked. And what that means then is if you look at the bank stocks now, basically, it's going to be very difficult for them to go much higher because APRA and the government will step in whenever it looks like lending's reaccelerating to try and stomp on it. So I can't see banks really going much higher from here. They may recoup some of their losses. And then on the other hand, resources, well, then it really comes down to your view on China. One of our analysts is in China this week, so we will be able to report a bit more on that when he gets back next week. But all the news flow we hear is that they're tightening rather than loosening, and generally tightening is not great for resources.
And it's interesting when you look at the consumer, for example. I mean, spending is pretty tepid, isn't it? We've been seeing those woes in the retail space. Retail figures tomorrow will be certainly very, very interesting, but almost a bit of a canary in the coal mine, if you like, for potential of what could come in the financial space if you look at the consumer and how things are playing out in that sector right now.
Yeah, if you consider consumption accounts for about 65 to 70% of GDP, and if you look what's happening to a lot of these stocks, whether it be Harvey Norman through to the retailers here discounting already this week for their winter sales, it doesn't look good on GDP numbers. So some of the early estimates we're seeing now is GDP in Q1 may be negative again. It's going to be a line ball number. If it's positive, it will be barely positive. So Australia will have had 2 out of 3 quarters being negative here. So if you take those as early lead, if consumers aren't spending much, consumption ultimately leads through to GDP. Without GDP growth, people aren't going to borrow more. So yes, I do agree with you there that these consumer stocks could be a canary in the coal mine.
Chad, can't let you go without bringing it up. New South Wales and Queensland, of course, the rivalry continuing tonight in the state of origin. Probably, well, look, hate to say it, but Queensland's certainly dominated over the last decade or so. Let's hope they can maybe break that tonight. But quite a different story if we take a look at it from a business point of view in the business world.
Yeah, just on a bit more of a light-hearted note that quite a few of my Queensland friends like to lord it over us down here, that their dominance, as you said, in the rugby league. What I thought I'd point out today is New South Wales' dominance in the economic statistics in the last 3 to 4 years. Just some simple stats that New South Wales has created over 200,000 jobs in the last 3 years. Queensland, on the other hand, has only created 50,000. Unemployment in Queensland's got a 6 handle. It's got a 5 handle here in New South Wales. And house prices here are up over 75% versus 15%. So for all the Queenslanders watching up there, they may be winning and they may win tonight, but New South Wales should comfort themselves that their economy is chugging along quite well.
Yeah, fantastic. Go the Blues tonight. Hey, let's hope they can do it for us. Chad, we appreciate you joining us. Thank you so much.
Thanks a lot.
That was Chad Slater joining us there from Morphic Asset Management. Some interesting points that he did raise there.